Welcome back to Mr. Greenvestor. If you look at your income today compared to 10 years ago, you are likely making significantly more money. Yet be honest, has your freedom date, the day you can actually stop working, moved any closer? For many of you watching, the answer is no. You feel like you are running faster just to stay in the same place. The problem usually isn't your income, and it isn't even the market crashing. The real threat to your retirement is much quieter. Think of your wealth building like a bucket. You are pouring water in with a massive shovel, your salary, but the bucket has holes drilled into the bottom. It doesn't matter how much you pour in if the system itself is draining your progress. Today, we are going to identify 5 specific mathematical leaks that are draining your future, and we are going to plug them right now. Leak 1. The lazy portfolio tax, expense ratios. The first leak is likely costing you 6 figures, and you probably don't even see it on your monthly statements. This is the lazy portfolio tax, otherwise known as high expense ratios. This happens when you leave your retirement accounts in default investment funds or actively managed mutual funds, where a human manager tries to pick stocks to beat the market. You might see a fee of 0.75% or 1% and think it sounds tiny. That is the trap. You aren't just losing 1% of your money, you are losing 1% of your compounded growth annually. Over a 30-year period, a 1% fee doesn't cost you 1% of your returns. It consumes over 25% of your total potential wealth. Let's look at the math on a $500,000 portfolio over 20 years. If you invest that money in a low-cost index fund, 0.05% expense ratio, versus an actively managed fund, 0.75% expense ratio, the difference isn't small. You lose tens of thousands of dollars purely to fees. That is money funding a fund manager's retirement instead of yours. The research is clear on this. Data consistently shows that 80% to 90% of actively managed funds underperform their simple index benchmarks over the long term. You are effectively paying premium pricing for a product that works worse than the generic version. The fix here is an audit. Log into your 401k or brokerage account today. Look at every fund you own and find the expense ratio. If you see anything above 0.20%, you need to ask why you own it. Unless it is a very specific sector fund you have high conviction in, you are likely paying a laziness tax. Swap those high-fee funds for broad market index funds or ETFs, where the fees are often 0.03% or lower. This one switch stops a massive leak immediately. Leak 2. The cash drag, the inflation gap. Once you stop overpaying Wall Street, you need to stop overpaying your bank for the privilege of holding your own money. This brings us to the second leak, cash drag. This is the habit of keeping too much cash. Your emergency fund, your short-term savings, or just buffer money, in a traditional checking or savings account. This leak is dangerous because it feels responsible. You see a healthy balance in your checking account, and it feels safe. But in financial terms, that money is rotting. Traditional checking accounts often pay 0.01% interest. Meanwhile, inflation in 2026 is projected to hover around 2.6% to 3.0%. That means every year you leave $50,000 sitting in a standard bank account, it loses about $1,500 in purchasing power. You aren't keeping your money safe, you are guaranteed to lose value. Let's run the numbers on a $50,000 emergency fund over 10 years. If you leave it in a big bank account earning 0.01%, you will earn practically zero interest, maybe enough to buy a cup of coffee once a year. If you move that same $50,000 to a high-yield savings account, HYSA, earning 4.0%, the math changes drastically. Over a decade, that account doesn't just sit there. it generates roughly $24,000 in free money, assuming you reinvest the interest. This is the interest rate gap. Banks take your deposits, pay you 0.01%, and lend that money out for a mortgage at 6% or a credit card at 22%. They keep the spread. When you leave cash in a low-interest account, you are donating your potential returns to the bank's shareholders. The actionable step here is simple but urgent. You need to segregate your money, keep only 1 to 2 months of living expenses in your checking account for bills, move your emergency fund and any short-term savings goals into a high-yield savings account immediately. You want your safe money to match or beat inflation, not get eaten by it. This takes about 15 minutes to set up, and it plugs a leak that silently drains your buying power every single day. Leak 3. The future self-betrayal, lifestyle creep. Now that your cash is efficient, let's look at how you handle your raises. This brings us to leak 3. The future self-betrayal, or lifestyle creep. This is the subtle habit of automatically increasing your spending every single time your income goes up. You get a promotion or pay off a loan, and instead of capturing that cash flow, it disappears into nicer dinners, a better car, or unused subscriptions. This leak is dangerous because of the double negative impact. Increasing your lifestyle hurts you in 2 ways. First, you fail to grow your nest egg because that extra money isn't invested. Second, you increase the amount needed to sustain your life in retirement. If you live on $60,000 a year, you need roughly $1.5 million to retire. If your lifestyle creeps to $80,000, your required number jumps to $2 million. You are moving the finish line further away? Suppose you are 40 and receive a $5,000 annual raise. If you spend it all, your retirement date stays put. But if you invest just 50% of that raise, $2,500, at a 7% return over 25 years, that single decision adds nearly $160,000 to your net worth. Apply that logic to every raise for the next 2 decades, and the compounded difference is massive. This leads to the 50% rule. Commit right now that for every extra dollar that enters your life, whether from a raise, a bonus, or a paid-off debt, you will invest half of it before it ever hits your spending account. You can enjoy the other half. Go get the nice dinner. But the first half belongs to your future self. The actionable step is to set up auto increases on your 401k contributions or automated transfers to your brokerage account to coincide with your annual review cycles. If you never see the money in your checking account, you won't miss it, and you stop the leak before it starts. Leak 4. The asset location error, tax inefficiency. You are saving the money, but are you keeping it away from the IRS? This brings us to leak 4, the asset location error. This is distinct from asset allocation, which is what you buy. Asset location is about where you hold those investments. The leak happens when you hold tax-inefficient assets in taxable accounts, effectively volunteering to pay higher taxes than necessary. Think of it this way. Different investments are taxed differently. Interest payments from bonds or dividends from real estate investment trusts, REITs, are often taxed at your ordinary income tax rate, which is likely the highest rate you pay. If you hold these assets in a standard brokerage account, the IRS takes a bite out of your returns every single year. We call this tax drag. It acts like friction on a wheel, slowing down the compounding process significantly over time, because that money is sent to the government instead of staying in your account to grow. Here is how the math plays out. Imagine you have 2 assets, a high-growth stock index fund and a high-yield bond fund. If you put the bond fund in your taxable account, you might pay 24% or 32% tax on the interest every year. That reduces a 5% yield down to a roughly 3.5% effective yield. Over 20 years on a $100,000 investment, that tax drag doesn't just cost you a few dollars. It could cost you upwards of $40,000 in lost growth compared to holding that same bond fund in a tax-sheltered account like an IRA or 401k. The strategy is straightforward. You want to shield your highest tax assets. Keep investments that generate regular interest income, like bonds, REITs, or actively managed funds with high turnover, inside your tax-advantaged accounts like IRAs and 401s, KKs. In your taxable brokerage account, you want to hold tax-efficient assets, primarily broad market index ETFs. These funds rarely sell shares, meaning they generate very few capital gains taxes until you decide to sell them years down the road. Your actionable step is to review your portfolio map. Don't just look at what you own, but look at the account type it sits in. If you have a bond fund sitting in a taxable brokerage account, while your IRA is full of S&P 500 index funds, you are likely donating money to the government. Swap them. Put the bonds in the IRA and the stocks in the brokerage. It effectively increases your after-tax return without you having to take on a single ounce of extra risk. Leak 5. The good debt justification. Finally, we need to address the debt you've become comfortable with. Leak 5. The good debt justification. By your 40s, you often carry medium interest debt, like car loans or HELOCs, thinking the rate isn't that bad. You justify it because you can afford the monthly draft. But debt payments in your 40s represent cash flow that should be catching up on retirement contributions. Every dollar sent to a bank is a soldier fired from your wealth-building army. Consider the opportunity cost. Suppose you have a $600 monthly payment on a luxury SUV. If you invested that same $600 at a 7% return over 10 years, you wouldn't just have a paid-off car. You would have over $100,000 in your investment account. That is the real cost of the car payment, $100,000 of wealth voluntarily given up. Furthermore, carrying debt into your pre-retirement years increases your risk profile. Debt keeps your fixed monthly costs high. The higher your fixed costs, the larger the nest egg you need to feel secure. If you eliminate these payments now, you lower the amount of income you need to survive, which effectively brings your freedom date closer. The actionable step here is to stop treating these loans as permanent fixtures of your budget. Create a debt snowball plan to attack these balances aggressively. You want to enter your security phase completely debt-free, so every dollar of income belongs to you, not a lender. To conclude, let's calculate exactly what plugging these leaks does for your future. When you stop paying high fees, move your cash to high-yield accounts, invest half your raises, place assets in the right accounts, and eliminate debt, you aren't just saving pennies. You are sealing a vessel that compounds wealth automatically. The final math is powerful. For the average 40-year-old, fixing these 5 leaks generates an additional $15,000 to $20,000 per year in safe retirement income at age 65. That is money you don't have to work for. It comes from simply fixing the system. Don't let invisible leaks dictate your retirement date. Fix the system today to secure your future.